welcome to the Department of Consumer Affairs webinar. Today's topic is on credit card basics. My name is Adam Burr, and I'm one of the attorneys here at the department. I help protect consumers by making sure that businesses follow the law. Now, usually when I'm asked to give a presentation, I'm speaking to businesses about their various legal duties, so it's nice to be able to speak to consumers about some of the laws that the department administers and enforces. Now, I've been with the department for 5 years, and during my time at the department, I've bought 2 cars, I bought a house, and I use my credit card to pay for pretty much everything else that I buy. So that makes me a consumer just like you. All right, so now we'll cover the history of credit cards. Now, I'll just give you a fair warning. In college, I studied history, so I'm like this big history nerd, and when I was doing research, I just got lost in it, and I thought it was fascinating. So let's get to the history of credit cards. Now, believe it or not, the history of credit cards actually goes back to 1887. In 1887, Edward Bellamy wrote the novel Looking Backward, 2000 to 1887. In this novel, he describes a future in which cards are used for payment in the year 2000. He calls them credit cards, but the way that he describes them would actually make them more akin to debit cards than credit cards. Now, in the late 1800s, some merchants started using charge cards or charge coins, and some of them could fit on a key ring. Now, a charge card is different from a credit card. Charge cards allowed purchases to be made on credit, but they had to be paid off the next month. Whereas credit cards, you can pay them off later and you can keep adding on to your balance. Now, they usually had the charge account number along with the merchant's name and logo. Now, in 1928, the charger plate was invented. This was a 2.5 by 1.25 inch rectangle of sheet metal, which was related to the old addressograph and the military dog tag systems. So these were embossed with the customer's name, city, and state, and they had a small paper card on the back for a signature. And when purchases were made, the plate was laid in a recess and in a printer with a charge slip placed on top. Now, sometimes these plates were kept in the stores rather than with the customers, and charger plates sped up the back office bookkeeping and reduced copying errors that were done manually in paper ledgers in each store. In 1934, American Airlines and the Air Transport Association introduced the Air Travel Card, which was still a charge card, not a credit card. Now, this card created a numbering scheme that identified the card issuer as well as the customer account. And this numbering scheme is actually the precursor to our modern numbering system. Now, just an FYI, under our modern numbering system, when you look at a credit card, the various numbers mean things. So the first group of numbers is the bank identification number. And this number tells you the type of card, such as a credit card or a debit card, as well as the issuing bank. Also, the first number tells you the payment processor. American Express cards start with a 3, Visa cards start with a 4, MasterCard cards start with a 5, and Discover cards start with a 6. After the bank identification number, the next group of numbers is the account number, and the final number is the control number. So now, going back to the Air Travel Card, customers could buy now and pay later for a ticket against their credit, and they could receive a 15% discount at any of the accepting airlines. And by the 1940s, all of the major US airlines offered air travel cards that could be used on 17 different airlines. By 1941, half of the airline's revenues came through the air travel card agreement. And in 1948, the Air Travel Card became the first internationally valid charge card within all members of the International Air Transport Association. Now, in 1950, Diners Club was formed. The idea was for a single general purpose charge card that could be used at a variety of merchants. This actually got started by accident. Frank McNamara, one of the founders of Diners Club, was dining with clients and realized that he left his wallet in another suit. So his wife ended up paying the bill, but McNamara thought of the idea of a multi-purpose charge card as a way to avoid similar embarrassment in the future. Now, the Diners Club was originally a means of payment at restaurants in New York City, but it later expanded to other merchants, including hotels, car rental companies, and flower shops. Now, so far, the history that we have looked at have all been for charge cards, not credit cards. Various banks tried to launch true credit cards, but they were not successful. However, that changed in 1958. So Bank of America launched the Bank America card in Fresno, California. This was the first successful revolving credit financial system in which a card issued by a third-party bank was being generally accepted by a large number of merchants. Bank of America chose the city of Fresno because 45% of Fresno's residents used the bank. The cards were sent to 60,000 residents at once, which enabled the bank to convince merchants to accept the card. This idea was eventually licensed to other banks across the US and then around the world. And in 1976, all Bank Americard licensees united themselves under the common brand name Visa. Now, some banks in upstate New York were denied a licensing agreement from Bank Americard. So in 1966, several banks in the upstate New York market joined forces and established Interbank Card Inc. to form its own credit card known as MasterCharge to compete with Bank of America's Bank Americard. In 1979, MasterCharge became MasterCard. And in 1973, Visa developed a method for the system to be computerized, which allowed for a reduced transaction time. So now we'll cover consumer credit cards. So first, let's look at some of the definitions because this is really the key to understanding about credit cards. So first, we have a card holder. This is a person to whom a credit card is issued or who has agreed with the card issuer to pay obligations arising from the issuance or use of the card by another person. So essentially, this is you, the consumer. The card issuer is the person who issues a credit card. Essentially, this is your creditor. Now, a lender credit card or similar arrangement is an open-end credit arrangement or loan arrangement other than a seller credit card, pursuant to which a lender gives a debtor the privilege of using a credit card, letter of credit, or other credit confirmation or identification, and transactions arising out of which debt arises by the lender's honoring a draft or similar order for payment of money drawn or accepted by the debtor, by the lender's payment or agreement to pay the debtor's obligations, or by the lender's purchase from the obligee of the debtor's obligations. Or an open-end credit agreement under which a person can effect an immediate advance by check or other draft qualities as a lender credit card or similar arrangement. So a good example of a lender credit card would be a credit card issued by a bank. So if you were to go to your bank and open up a credit card, it would be a lender credit card. Now, a seller credit card is an arrangement pursuant to which a person gives a buyer or a lessee the privilege of using a credit card, letter of credit, or other credit confirmation or identification, primarily for the purpose of purchasing or leasing goods or services from that person, a person related to that person, or others licensed or franchised to do business under his business or trade name or designation. So an example would be a store credit card that is not backed by any bank. Probably a good example would be like a gas credit card. seller credit cards are actually becoming quite rare. The reason is because the trend is for retailers to issue what are so-called co-branded credit cards. So essentially they are backed by a bank, so they're lender credit cards, but they still allow for you to take advantage of the retailer's perks when they're used at the retailer. And oftentimes they will have the logo of the credit card processor so that they can be used at other retail stores that are part of the credit card processors network. All right, so kind of a good example. A long time ago, Belk actually issued its own credit cards, so those would be seller credit cards. But Belk has since changed its business model to the kind of the co-branded one. So now when you go and you get a Belk credit card, it's actually backed by a bank, and then you can use it as a lender credit card, but you still get all the perks that Belk offers to its customers for its credit card. Now, a credit service charge are all charges payable directly or indirectly by the buyer and imposed directly or indirectly by the seller as an incident to the extension of credit. And these would only apply to seller credit cards. But similarly, there's what's called a loan finance charge, and these are charges payable directly or indirectly to a debtor and imposed directly or indirectly by the lender as an incident to the extension of credit. And these apply to lender credit cards, and you can think of a loan finance charge as kind of like interest. So now let's take a look. Let's talk about what a consumer credit sale is. So it is a sale of goods, services, or an interest in land in which credit is granted by a person who regularly engages as a seller in credit transactions of the same kind. The buyer is a person other than an organization. The goods, services, or interest in land are purchased primarily for a personal, family, or household purpose. Either the debt is payable in installments or a credit service charge is made. And with respect to a sale of goods or services, the amount financed does not exceed $115,000. Now, it does include sales made by a seller credit card, but not a lender credit card. Now, note this $115,000 is the amount as of today. However, effective July 1st, the amount will increase to $127,500. So now we'll go over a consumer loan. So it's a loan made by a person regularly engaged in the business of making loans in which the debtor is a person other than an organization. The debt is incurred primarily for a personal, family, or household purpose. Either the debt is payable in installments or a loan finance charge is made, and either the principal does not exceed $115,000 or the debt is secured by an interest in land. Now, a loan includes the creation of debt pursuant to a lender credit card or a similar arrangement. Now, when you go to a retail store to make a purchase, if you use your seller credit card, it's going to be a credit sale. However, like we talked about, that is increasingly rare. You're likely going to be using a lender credit card. So when you use a lender credit card, it is a loan. And why that matters is that it determines the identity of your creditor. And for purposes of this presentation, essentially your creditor is the card issuer. So if you're using a seller credit card, then your creditor is the retailer. If you are using a lender credit card, then your creditor is the issuing bank and the retailer is just the person honoring the credit card. So when you use a lender credit card to buy goods at a retail store, from the retailer's perspective, it is a cash sale. But from the bank's perspective, it is a loan because you now have an obligation to repay the bank. And as with consumer credit sales, effective July 1st, the a dollar amount threshold will increase from $115,000 to $127,500. Now, as you may be aware, there are 4 major credit card networks. They are Visa, MasterCard, American Express, and Discover. Now, we saw Visa and MasterCard earlier. Since their founding, both Visa and MasterCard have changed their business models, and they are now payment processors only. They do not issue any credit cards, so accordingly, Visa and MasterCard are not your creditors. Now, American Express and Discover are both processors and card issuers. And accordingly, American Express and Discover can be your creditors. And the reason for this is that both American Express and Discover are chartered as national banks. And that's why they're able to serve as both the processor and the card issuer. Now, when you go to a retailer and use your credit card at the point of sale terminal or the register, then you will typically be approved or denied in a matter of seconds. If approved, your purchase is complete and you can leave with your items. However, a lot happens with the credit card infrastructure within those few seconds. The first stage is called the authorization stage. So you use your credit card at the merchant to make your purchase. The merchant then sends the credit card details to its acquiring bank. The acquiring bank then forwards the credit card details to the credit card processor along the credit card network. The credit card processor then requests payment authorization from the issuing bank. The next step is the authentication stage. So first, the issuing bank verifies the information that it received from the credit card processor. If funds are available, then the issuing bank will send an approval code to the merchant. It will be sent to the credit card processor, who will forward it to the acquiring bank, who will then forward it to the merchant. The merchant's payment terminal collects all approved transactions in a batch. The merchant then issues a sales slip or receipt to you to complete the sale, and then you are free to go after completing your purchase. This happens for every transaction made via credit card, and it all occurs in a matter of just a few seconds. Now, the last step is clearing and settlement. The merchant sends the batch of approved transactions to its acquiring bank. The acquiring bank then forwards the batch to the credit card processor along the credit card network. The credit card processor then sends the approved transaction to the appropriate issuing bank. The issuing bank then transfers the funds to the acquiring bank less an interchange fee. And this is accomplished by sending the funds to the credit card processor. The credit card processor then pays the acquiring bank its percentage of the remaining funds, and the acquiring bank then credits the merchant's account less a merchant discount rate. In the meantime, the issuing bank posts the transaction to your account, and then you pay the bill to the issuing bank. Now, as you saw from the previous slide, due to interchange fees and the merchant discount rates, merchants rarely get paid the full amount of the purchase when you use your credit card. Now, some merchants will absorb the expense as a cost of doing business. Others want to pass along that cost to the consumers in the form of surcharges. Now, we get numerous inquiries from consumers about whether merchants may legally impose these surcharges on consumers. Now, it is a complicated issue and the intricacies go well beyond the scope of this presentation. But in short, yes, these surcharges can be imposed on consumers. It is not the result of a law. Instead, it is the result of a settlement agreement. Now, the settlement agreement has some pretty complex rules, but as long as the rules are being followed, surcharges can be passed on to the consumers. The surcharges are limited to 3 to 4%, depending on the type of the credit card, and they must be disclosed either on the sales receipt or on a sign close to the register. Now, a new settlement agreement was reached in March, which could potentially lower surcharges in many cases for the next 5 years. However, this settlement is not definitive yet. The department is not a party to this settlement agreement and does not enforce it. And while the department is always happy to attempt to mediate disputes between businesses and consumers, specific concerns about these surcharges probably should be addressed with the individual merchants, the issuing banks, or the payment processors. Now let's talk about the fraudulent use of credit or debit cards. Anyone who knowingly uses, attempts, or conspires to use any counterfeit, altered, forged, lost, stolen, or fraudulently obtained credit or debit card to obtain money, goods, services, or anything of value is guilty of a misdemeanor and can be fined up to $5,000, imprisoned for up to 1 year, or both. Now let's talk about the limitation of damages for the fraudulent use of credit or debit cards. So your liability for unauthorized use of a credit card is $50. If you report the loss before your credit card is used, you do not have any liability for unauthorized charges. If you report the loss, if the credit card number is stolen, but not the card, then you do not have any liability. Now, for debit cards, you do not have any liability if the debit card is reported as lost or stolen before the unauthorized use. Your liability for the unauthorized use of a debit card is $50 if it is reported within 2 business days of the loss or theft. Your liability for unauthorized use of a debit card is $500 if it is reported between 3 and 60 days of the loss or theft. There is not any liability protection for unauthorized use of a debit card if you report it more than 60 days after the loss or theft. So now let's look at some fraud prevention requirements that are placed on credit card issuers. If the card issuer mails an offer or solicitation to receive a credit card, and in response, it receives a completed application with an address that is substantially different from the address where it mailed you the offer, then it must verify the change of address by contacting you or using other reasonable means of verifying your identity. Now let's look at another fraud prevention requirement that is placed on credit card issuers. If the card issuer receives a written or oral request for a change in your billing address, and within 30 days of the notice, it receives a request for an additional credit card, then unless it has verified the change of address, it may not mail the requested additional credit card to the new address or activate the requested additional credit card. Now, here are some steps that you can take to prevent a fraudulent credit card from being opened in your name in the first place. Consider placing a fraud alert on your credit file. When a fraud alert is in place, potential creditors must take additional steps to verify your identity. It is free to place and it lasts for 1 year. And you only have to call one of the credit reporting agencies, and that agency will call the other 2. You should also consider placing a security freeze on your credit file. When you have a security freeze in place, no new lines of credit can be opened until you temporarily or permanently lift the freeze. It is free to place and it lasts until you lift it. You'll be given a unique PIN to use to lift the security freeze. You must notify each of the 3 credit reporting agencies, Experian, Equifax, and TransUnion, to place the security freeze. Now, speaking from personal experience, I cannot stress enough the importance of placing a security freeze on your credit file. In the 5 years that I've been employed with the department, I have been a victim of identity theft 4 times. Each time someone tried to open a credit card or take out a loan in my name. Only the first time the merchant stopped it because it suspected fraud. The other 3 times I found out about it when the merchant sent me a letter requesting that I remove my security freeze to complete the transaction. So in other words, but for the security freeze, the credit cards would have been opened in my name. The security freeze therefore did what it was intended to do. Now, if you do put a security freeze on your account, you still can use your credit cards that you currently have. And if you want to lift the freeze to get new lines of credit, let's say you're in the market for a new car, it takes about an hour to lift the freeze. So by the time that you call all 3 credit reporting agencies, you get to the dealership, you test drive the car, you deal with the salesman, and you're ready to negotiate a price and open up a new line of credit, then it probably has been an hour at that point. And then you get the new line of credit, you can put the security freeze right back on. So now let's look at your rights regarding credit cards under the Consumer Protection Code. So first, we have the maximum rate schedule. If a card issuer wishes to charge a credit service charge or a loan finance charge exceeding 18% APR, then it must annually file a maximum rate schedule with the department, post the maximum rate schedule in a conspicuous place at its central and branch offices, and include a conspicuous statement of the maximum rate in the initial disclosures required by the Federal Truth in Lending Act. And if the maximum rate changes, then the card issuer must notify you prior to the effective date and the change of the maximum rate. So now let's look at delinquency charges. Delinquency charges can only be imposed if you agree to them before entering into a contract with the card issuer. They cannot be imposed until 10 days after the due date passes and the debt has not been paid. And this is essentially day 12. Day 1 is the payment due date. Days 2 through 11 are the grace period. And on day 12, the delinquency charge can be imposed. Now, delinquency charges are limited to the lesser of 5% of the unpaid installment or $23 unless a minimum delinquency charge was contracted for. So in that case, the minimum delinquency charge can be $9.20, even if that is more than 5% of the unpaid installment. And these numbers will increase on July 1st to a maximum delinquency charge of $25.50 and a contracted for a minimum delinquency charge of $10.20. Now, the Consumer Financial Protection Bureau has implemented a new rule that would reduce delinquency charges for credit cards to a maximum of $8. Now, that rule is currently being challenged in the courts. So during the pendency of that litigation, that rule has been stayed. So now let's talk about the notice of the right to cure. A right to cure must be sent to you when you are more than 10 days late. And essentially, this is on day 12. Day 1 is the payment due date. Days 2 through 11 are the grace period, and day 12 is the day of default. You have not voluntarily surrendered possession of the collateral, and a notice of a right to cure has not been sent to you in the previous 12 months. The notice must be sent before the creditor accelerates maturity of the unpaid balance of the obligation or takes possession. Sorry, I clicked a little too fast. Or takes possession or otherwise enforces a security interest in goods that are collateral. Right. A creditor may not take assignment of your earnings for payment or a security for payment of a debt. You can authorize your employer to pay your creditor by having payments deducted from your pay, provided that that authorization is revocable. Attorney's fees must be contracted for to be enforceable against you. And attorney's fees are limited to 15% of the unpaid debt after default and referral to an attorney who is not a salaried employee of the creditor. Now, sometimes your debts will be sold to other creditors. This is called assignment. You are authorized to pay your original creditor until you receive notification of assignment of rights to payment, and that payment is to be made to the assignee. A notification that does not reasonably identify the rights assigned is ineffective. You may request proof that an assignment has been made, and the assignee must seasonably furnish reasonable proof that assignment has been made. And if the assignee does not provide the proof, then you can continue to pay your original creditor. Right. Changes in the terms of your cardholder agreement. If a change increases the rate of the finance charge or the credit service charge of additional charges, alters the method of determining the balance upon which the charges are made so that increased charges may result, or imposes or increases minimum charges, then the change is effective only if you agree to the changes after receiving written notice of the changes, or the creditor mails you a notice of the change at least 45 days prior to the change. Now, I have an asterisk there because our law says 30 days. However, the Card Act, which we'll get to next, says 45 days. So in this instance, the federal law trumps the state law. Now, if you do not agree to the changes, your creditor may terminate the account and allow you to pay off the balance under the old terms. Now we come to the Card Act of 2009. The Card Act was passed by Congress and signed by President Obama in 2009. And the Card Act was passed with wide bipartisan support, and it offers significant consumer protections for credit cards, debit cards, and gift cards. So let's explore some of those protections. All right, first, retroactive rate increases. With limited exceptions, there generally cannot be any retroactive increases in the APRs of outstanding balances. But let's look at some of those exceptions. The first exception is the expiration of a promotional period if the required disclosures were made to you prior to the beginning of that promotional period. Now, many credit cards will offer introductory APRs for a few months that will increase after the expiration of that introductory period. The second exception is an increase in a variable APR tied to an index not under the control of the creditor and available to the general public. So an example of this might be a rate of prime plus 12%, with the prime rate being the prime rate published by the Wall Street Journal on a daily basis. The third exception would be the completion of a workout or temporary hardship agreement if the required disclosures were made prior to that agreement. And the last exception is if the minimum payment has not been made within 60 days of the due date, if the required disclosures were made beforehand, and the rate increase expires within 6 months if the required minimum payments are timely made during that time period. Universal default allowed a creditor to raise your APR if you were more than 30 days late on another card. This practice is now banned under the Card Act. Excess payments are now required to be applied to the highest interest balance first. Double cycle billing is kind of a difficult concept, but let's explain it. It was a practice in which interest was applied to the prior 2 months outstanding balances. Double cycle billing is now prohibited under the Card Act. So interest cannot be calculated on the average of the previous and current month's balances. So for example, a consumer may have a balance of $1,000 in January and $400 in February. And that's not uncommon because of the holiday seasons in December. Consumers typically spend more. You're going to put more on your credit card in December that you will pay in January. So it's not uncommon to have a higher balance in January than you would in February. Now, interest for February must be calculated on the February balance of $400 instead of the average of January and February of $700. Prior to the passage of the Card Act, a consumer could have paid off the balance in a previous month, but still be charged interest on the previous month's balance because the average of the 2 months would include debt that had already been paid off. So in other words, double cycle billing would often charge consumers interest on debt that had already been repaid, a practice that was completely unfair to consumers. The Card Act now requires payments to be due on the same date of each month by 5 o'clock. Prior to the passage of the Card Act, payments could be due on varying dates of each month and at strange times. You must opt in to incur over the limit fees. Over the limit fees may only be imposed once per billing cycle. Over the limit fees may only be imposed once in the 2 subsequent billing cycles unless you obtained an additional extension of credit in excess of your credit limit during any subsequent cycle, or you reduce the outstanding balance below the credit limit at the end of such billing cycle. Now let's look at some aids. May be issued a credit card unless there is a cosigner of someone that is 21 or older, or the consumer is able to provide proof of an independent means of repayment. The cosigner must also provide written consent to increase credit limits. Additionally, a card issuer may not offer any tangible item to induce a college student to apply for a credit card on campus, near campus, or at an event sponsored by or related to the college. Prior to the passage of the Card Act, it was a common practice for card issuers to go to college campuses and get students to sign up for a credit card by giving them a hot dog or a t-shirt in exchange for them signing up for a credit card. Now let's examine some of the pros and cons of credit cards. As a consumer, it is ultimately your decision about whether to open a credit card and whether to use it. Now, some of the pros of credit cards are they can help you make purchases that you might not otherwise be able to purchase. Often they have perks such as cashback, Sky Miles, or other rewards. Using your credit card and making payments on time can help improve your credit score. And having more credit cards can help lower your credit utilization ratio, which can improve your credit score. However, this is a double-edged sword, which we'll talk about when we get to the cons of credit cards. And often credit cards are safer than cash. Now, some of the cons of credit cards are statistically, you are more likely to spend more with a credit card than with cash. According to a report from the Federal Reserve Bank of Boston, the average value of a cash sale was $22 compared to $112 for a non-cash transaction such as a credit card. Now, if you think about it, if you want to go to a store and buy a shirt and you only have $10 cash in your pocket, you can only buy the shirt if it is $10 or less. Let's say you find the shirt, but it's $12. With the credit card, you might say it's only an additional $2. I'll go ahead and buy it. Now, frequent use of credit cards can incur increased credit card debt, which can quickly become unmanageable. Kind of the other side of that double-edged sword that we talked about earlier about opening multiple credit cards. So opening a new credit card counts as a hard inquiry, which can lower your credit score. And if you do not pay the bill in full each month, then you will pay interest. I thank you for watching this presentation, and I hope that you enjoy the rest of your day.